Hi, I'm Dennis Rodkin. I write the Deal Estate column for Chicago Magazine, and this is DEQs, where I answer readers' real estate questions. Joshua in Lincoln Square asks, my wife and I are in our early 30s, have good jobs and a good income. We have a modest savings of $30,000 that will grow quicker now that we're both finished with graduate school. But we're still at least several years away from being able to buy a fairly modest home. When I consider that my generation as a whole is saddled with student loan debt and struggling in the job market, I imagine that I'm closer to home ownership, if I want it, than most. But I wonder where the new home buyers are going to come from. Do prices need to come down to a point where someone like me and the many people worse off than me could afford a home? Well, can I just start, Joshua, by saying that having $30,000 in savings does put you way ahead of a lot of other buyers, not only the first-time buyers, but the move-up buyers. First-time buyers, of course, have a very hard time saving. They're typically in starter jobs. Their incomes haven't grown to the point where there's space for savings yet. And on top of that, as you mentioned, there's student debt and other overhangs that make it very, very difficult to save. But at the same time, the move-up buyer is, in many cases, behind you. Classically, before moving up, I would take the equity from my old house and roll it over into the new one. But home values are down so far, my home equity has shrunk so far that I think there are a lot of middle-class move-up buyers who would be really happy if they even had the $30,000 you have. Many of them are so far underwater that getting back up to $30,000 equity would feel like a great thing. That's not to say it's a bad thing for you to have saved. That $30,000 you have is going to be used as a 20% down payment. That's what's standard now, you know that, but it used to be that you could have used that as your 3.5 or 5% stake in a house. You'd have been able to afford much more of a house. Prices were higher then, but you'd have greater affordability. One of the things we're seeing recently is those very high down payment rules are outweighing the advantage of the sweet interest rates that are available. Andrew Davidson and Company, a mortgage consulting firm, put out a report very recently that said that the cost of saving up that enormous down payment, that much larger down payment, greatly outweighs the advantage that you get from the lower interest rates. That the cost of buying a house is in fact now higher because of down payments rather than lower because of the better interest rates. Now, it's true, of course, that interest rates aren't only what contribute to affordability. The other thing that seems to be making housing so affordable right now is that prices have come down so far. They've come down in the Chicago area about 25% in the past 6 years. Less in some parts of the region, more in others. And prices might fall even farther into 2012 because there are many more foreclosures coming onto the market. In May, there was a big spike. There were 50% more foreclosures, new foreclosures started in the Chicago area than in May a year prior. It is a good thing because it gets them through the pipeline, and once all the foreclosures are processed, our prices can stabilize and can start to tick up. And we are already seeing prices be bid up from the bottom in some parts of our region in the really desirable areas. But those foreclosures, until they're all processed, are going to continue to pull prices down overall. Then you have those additional factors you mentioned like job insecurity, student debt, and those are making it very difficult for a first-time buyer or for a potential first-time buyer even to move into the market. Fortunately, there's always population growth. That creates more demand. We have had outmigration from Chicago, but the people who are here are going to continue to grow up, create families, and want housing, whether for purchase or for rent. Those who want for purchase may, in many cases, move to new neighborhoods where we haven't been buying before. There are lots of parts of Chicago that have been forgotten about, that have been depopulated, where there is vacant land that may be built on. And what happens in many cases when housing is too expensive is that people go and colonize other neighborhoods that are less expensive. And that may be what a whole round of buyers does, because they trade away the zones of hipness, the allure of living in those places, for a place they can afford along with their student debt and the other things they're trying to service. So we may find that first, it's not just a question of where first-time buyers are coming from, but where they're going to. Where are they buying houses in some of these new neighborhoods we hadn't thought of in the past? And the reason they'll do that is there is an undeniable appeal to homeownership. The great majority of people say they want to own. There is a turn toward renting, but it is still far greater numbers who say they want to own. And people find ways to buy houses even in difficult times. In the early 1980s, our parents' generation, when they were buying houses, were looking at double-digit interest rates, nothing like we're seeing now. They peaked in 1981 at 18.6% and had been above 15% for several years, stayed there for several more. And yet, even at those what sound now like ridiculous interest rates, people did continue to buy houses. Thanks for your question. Send me more at dennis@rodkin.com.